All right. Hello, hello. I am Dawn Connors, and I'm excited to be joining you today. And with me is Dan Walker. So I thought I'd talk a little bit about myself, and then I'll have Dan join in and talk a little bit about himself and his experience. I myself have been in lending for 20 years, and my background is finance. And today we wanted to talk about some different options and thinking about mortgages and real estate. Dan, how about you?
Hey, Dawn, thanks. Yeah, I have been in investing and working with properties and all sorts of things probably for a little over 10 years now. And I have, in the past 7 or 8 years, I got my realtor's license, and then a couple years after I had it, I went ahead and started my own brokerage. I have my law degree, so I was able to start that a little bit sooner than I normally would, and have now kind of transitioned into having a full-time brokerage with a couple employees and doing some investing, whether it be rentals, residential, commercial, and now getting into even new builds and some flips and things like that. So trying to diversify, and I've worked with you now for probably about 4 years, I think, exclusively. So yeah, it's been a good time, and we're excited to be here and try to help some people navigate through what is going on with the industry and everything that's happening. We do have the ability for anybody who's watching to comment right here on the video, and we can kind of go into that way. As people kind of type their comments, we'll go ahead and answer them that way. But I guess to start off, Dawn, I'll go ahead and ask you maybe one of my own questions. A big thing that I'm seeing right now from a lot of my clients or potential clients, they want to know what is going to happen to their pre-approval process or even their current process with employment verification, because so many people are being laid off or furloughed right now that it really is, it's a big issue, as you know, when you're going through a mortgage process. So from your standpoint and the way that you understand it, how is the government and underwriting helping people who are, kind of in that situation right now?
Okay, so if I hear your question right, you want to talk about employment verification in the way of mortgages, and if a person can proceed with a mortgage if they're laid off, if they're working from home, if they've received a pay cut. Is that correct?
Yeah.
Okay. So if you're laid off and you're not working at all and you're receiving unemployment, you cannot close on a mortgage loan. You have to be returned back to work. You could start your mortgage process. You can get appraisals done if you wish. You can order title work. You can have your loan application made. You cannot close, though, on a home loan, mortgage, equity line of credit, or any other type of mortgage if you are unemployed currently. And that also holds true then for self-employed borrowers who, I have a client, for example, that owns 2 car washes. We have to check to make sure the car washes are operating. And because that business is not in operation, it's closed temporarily because of the Michigan temporary stay saying that it's not an essential business, that he can't close on his mortgage loan either until he's returned to work. On the other hand, if you are working from home and you are receiving your paycheck, you are able to close and to proceed on your mortgage financing. Or if you've received a pay cut, like for example, GM and Ford employees, for example, have received a 20% pay cut, you can also close on your loan as long as you qualify with the reduced wages. Even though it's maybe temporary in nature, those reduced wages, I still have to qualify you at the current income that you're receiving.
So that's definitely good to know for people who are out there watching and wondering, you know, if the sky is falling and if they can continue to go through with what they are, you know, trying to do with purchasing a new home. I know it's definitely been some new waters for us realtors to navigate as well. The other big question that I've been getting is what is happening right now to where people are getting, you know, they're within a week or two of the closing date per their purchase agreement, and all of a sudden they get a notification from their mortgage company, hey, underwriting is backed up 3 weeks. I just had this happen yesterday, actually, on a deal that was supposed to close this week. And the agent called me and said, hey, you know, underwriting is backed up 3 weeks. You know, can we push that out? Why is that happening right now?
There's been a lot of refinances that have kind of clogged the funnel. And so these refinances, some lenders are taking precedence and allowing the refinances to be basically, it's a system of problems. And so at Mortgage One, we hold purchases separately from refinances. So purchases always take precedence. So you wouldn't have that at Mortgage One because we don't allow for refinances to be above or in front of refinances. I'm sorry that that's happening, Dan.
Yeah, that is unfortunate. And, you know, for anybody who's out there watching right now, because it does look like we have quite a few here, that's definitely something to keep in mind when you're out there and you're, you know, either currently working with a mortgage company or considering working with a mortgage company or a lender to get pre-approved to buy a house. Is you really want to make sure that they're not bogging themselves down with refinances that are gonna hold up your sale, because it's a very, very tedious process, Dawn, as you know, certainly as I know, that you really don't want it to go any longer than it has to, because there's so many things that can happen to where, you know, underwriting flags it and then the approval is pulled, or you know, God forbid some incident happens where it may or may not be out of your control and it just completely changes everything. So that's definitely something people out there should take into account. And again, for people who are just joining in, feel free to as we're kind of having a conversation, put a comment out there, put a question. You can comment right underneath the video. We'll see it. And, you know, whoever it's directed towards will answer your question directly. This is, you know, really a learning experience for a lot of people. I have never seen this. I'm sure that most people have never seen this in their lifetime, and hopefully we never will again. But we just want this to be a resource for people to get professionals' opinions, you know, free of charge, and feel comfortable to ask any and all questions that they have during this, you know, really unprecedented and kind of scary time. So if you have a question, a comment, feel free to put it out there. That's what we're here for tonight.
All right, Dan, we got two questions. The first one comes from Brandon. He's saying, with the disruption in pay, will it have an impact after the fact, or will it be overlooked? I was told that banks accept 2 years of uninterrupted income. Brandon, that's a great question. In this situation, it's going to be seen as a special circumstance. For example, I'm going to be able to close loans immediately after your return to work with full-time pay and full-time return to work status. If a person is on part-time, they're going to probably need a letter that says that they're guaranteed a certain number of hours in order for me to use those hours. For example, if you're only working if you're part-time and you're 25 hours, I'm probably going to need a letter that also says that you're guaranteed to get those 25 hours a week when this is lifted. But full-time, you're going to be returning back to work. I'm going to be able to close on a pay stub or an employment verification. Nikki asks, hi, are you seeing a lot of drive-by appraisals? Yes, Nikki, I am seeing a lot of drive-by appraisals. This is what's happening. Conventional underwriting is allowing us to do drive-by appraisals, or what's called desktop appraisals, where an appraiser does not even go out to the house. They use the online data, the online information, and they give an appraisal valuation called a desktop appraisal. There's others that are doing drive-by appraisals, and that's also allowed, where an appraiser can drive by the property and see the appraisal. There are some situations and circumstances where it's not being allowed, and those are cash out refinances. So if you're pulling cash out or equity out of your house, the appraiser has to go into the house, and there are appraisers going into the home right now. The second one is FHA and VA and rural development loans are asking for the appraiser to go into the home. MSHDA loans are not. However, there's not an appraiser that's willing to put on the appropriate forms the appraisal information that's needed, because they're supposed to do a head and shoulders inspection of the attic, for example, and look for mold, and they're not able to do that and do a visual inspection. So government loans have been different, and I've been able to close every loan because mortgage lending is seen as essential, and then every ancillary service, for some reason, the exception of real estate agents. So, and Dan will talk more about that. But that means that home inspectors, appraisers, if they're willing to go into the home, pest inspectors, and contractors, for the sake of getting a deal closed. And we're able to we are closing loans, and loans are closing every day. Dan, do you want to lean into what's happening in real estate right now in regards to Whitmer's request to stay at home, and what essential services are for a lender versus a real estate agent?
Yeah, definitely. You know, I've had a lot of conversation with other realtors, as well as following what our association has obviously been in contact with Lansing, trying to get clarification on what's going on. And basically the way that it has shook out is that anything that we had in progress before the stay safe, stay at home order was put into effect, we are allowed to continue with that. And that is at, any point of the deal. It could have been left off at the appraisal and offer, wherever it may be, we are allowed to continue with that. If we have a closing, we can go ahead and continue along that path of the closing as it's going on. Where things really start to fall off, and I think that those who are paying attention and check on the market are seeing, is we are not allowed to go physically show a house. We cannot do that right now. And I know for myself personally, just in the past several weeks, I was supposed to have 4 different listings. And so trying to give my clients the best advice that I can when they're asking me, well, should we list? I mean, for me, it's really hard to say yes to that, because and I think most realtors will tell you, you have basically, your first 14 days are your most important days. And that's when you're going to get your most traffic, because you're the new show in town, right? And to not be able to physically have people come and see the house, I don't know. I can't think of too many buyers who are going to purchase a home sight unseen. You can look at the pictures, you can look at, a virtual tour, which I know is allowed. But you're not going to see all the intricate details. You're not going to get that feel when you walk in a house, that so many homeowners or buyers will say, it just feels like home, because you're not there. You're not going to smell that dog that lived there for 15 years and kind of made the house smell a certain way or whatnot. And so, my advice has been just to wait and to kind of ride this out, get it to a point to where this is done and it's safe to resume operations as normal, and try to get things back on track. It's definitely a huge curveball for our industry, especially realtors who we're not deemed essential in the order.
So, Dan, the next two questions that have come in is about forbearance. So we're going to change topics, if that's okay with you, and move over to the idea of forbearance and define what a forbearance means. And it's a loaded one. So this comes from Mary Writing and also from Brandon Smith. So let's talk about forbearance. Forbearance is if you cannot afford to make your payments, it is a way that your mortgage company is offering you to not make those payments because you can't afford it, and to have a different procedure done. So let's talk a little bit about that. For example, if you are not working, haven't received unemployment yet, you cannot make your mortgage payment, you're running the risk of not making April or May payment, you need to call your mortgage servicer and look into forbearance. If you are working and are able to afford your payments or have money stored away, it is the wisest thing for you to do to probably continue making your payments. Here's why. There are so many unknowns in forbearance, and all we can look at is past history and past experience. So let's talk about that. In 2008, 9, and 10, in the mortgage 7, 8, 9, and 10, in the mortgage meltdown previously, forbearance was a terrible experience for hundreds of thousands of people, millions of people, because they stopped making their payments, did the forbearance agreement, and were marked 30 days late, 60 days late, 90 days late, and up to 120 days late. And then people started getting their houses taken away from them because they had this forbearance agreement, but a forbearance agreement is not modification. It's not permanent modification terms. It's a temporary agreement. Your actual agreement is when you sign the mortgage and you sign the note. So anything outside of that, you would want to get in writing, number one. Number two, if your mortgage company marks you late, 30 days late, 60 days late, etc., your credit score drops and you cannot refinance, you cannot sell and buy another house for a period of 12 months to 3 years. You have eliminated your ability to get a mortgage and get financed. For one, your credit could be decimated. For two, your inability to buy because of the late payments that show on a mortgage will not allow for another lender to allow you to get a mortgage. So question number one that you want to ask your company if you're looking to forbearance, and if you don't have a choice, you don't have a choice. But if you have a choice, you want to think hard and long before you do forbearance. So forbearance is supposed to be structured that you have, at this time, it's on average, it's happening 3 months without payments, 90 days. At the end of the forbearance period, on that 4th month, many banks are saying that 90 days is due. U.S. Bank is one of them, for example. The 90 days is due and your current payment. So at the end of the forbearance, you have 4 payments that are due, for example. What do you do? What do you do if you can't make those payments? Well, then you have to seek out another agreement with the servicer at that time. And who knows what that agreement is going to look like or be like. In certain situations, I have heard that certain lenders are moving those payments to the back of the loan. Well, at the back of the loan, that means you're going to be charged interest and fees to get to the, and at the end that those payments will be due after your other payments are paid. So there's 3 or 4 questions that I would think are extremely important to ask. Number one, what happens during my forbearance period? Are you marking me late on the credit report? And if they say no, you're going to want to get it documented in writing. Number 2 question is, what happens after the forbearance period? Are the payments moved to the back of the loan, or are my payments due and payable at the end of the forbearance period in one lump sum? And then question number 3, if I can't make those payments, those 4 payments that are due at the end of that forbearance period, are you marking me late, 120 days late at that time? Because 4 payments, 4 months times 30 days is 120. So it's very, very dicey. And I can tell you time and time again, I've talked to hundreds of people back in 2008, 9, and 10, and it was just grievous stories of them because once you're marked late and the lates get so far, the bank can come in and foreclose, can take the house from you. If you don't have documents in writing, I even had clients that had documents in writing. They were told that it was a temporary modification, but because it wasn't a permanent modification, it didn't alter the terms of the initial contract. They were still marked late 30, 60, and 90 days. So totally scary stuff. I would never consider doing a forbearance unless it's absolutely mandatory. If you're not able to make your payment and you're going to be late anyhow, what choice do you have? You might as well take the options and roll the dice. But if you're just trying to get out of making your mortgage payment because you have a mild hardship or you have the money in the bank but you don't want to spend it, I wouldn't go that route. It is going to have dire consequences.
That's really, really good advice. And I would echo those same sentiments to anybody who's out there watching, that from everything that I've seen and everything that I've heard, working with so many investors, and there is a strong general consensus, and I actually I believe it, that the market as far as foreclosures in 6, 12, 18 months, it's going to be significant. And it's going to be significant because you're going to get people like you just talked about, Dawn, who have the ability to continue paying their mortgage right now. And they're going to realize that they have the opportunity to get one of these forbearances. And, it's just like several of these people I follow and read, the scenario they gave was basically, you're going to get this forbearance. Say your mortgage is, $1,000 a month. You're going to get a forbearance for April, May, and June. Okay. So you're not going to have to be paying that $1,000 a month. And it's somewhere in that time, whenever it may be, for an average family of 4, you're going to get about $3,400 from the government in stimulus money. That money, at as much as possible, should be saved so that you're able to make payments like your mortgage payment, make payments on your utilities, be able to buy the food and the necessities that you need during this time to get by. It has been proven time and time again, however, that people are going to look at it as, hey, we don't have a mortgage payment for the next 3 months. It's no big deal. And we just got a $3,500 check. Let's go buy that TV we've been wanting. Let's go buy that 4-wheeler, maybe that new car, whatever it may be. But then come July, for a lot of folks, they're going to get their mortgage, statement in July, and they're going to have to pay 4 payments on that July statement. And they're not going to have that money. And then you're pretty much in a hole so deep that you'll never get out of it. So that's really, really good advice. And I hope that anybody out there who, is considering doing that takes it to heart and understands that, to the extent possible, you should be continuing to make your mortgage payment, because there is so much uncertainty surrounding it.
There's a much better opportunity for, if you are employed, if you are working, even if you're working from home, if you're essential or you're working from home, even if your pay was cut, to look to refinance over forbearance, because you can miss up to 2 payments in refinancing. You can get an escrow refund back. So the current money that's sitting in your escrow account can get moved back to you. So let's say you have, for your taxes and insurance, you have $2,300 in your escrow account. You can get that money refunded back to you after refinance closing. skip up to 2 mortgage payments without having any late payments. So let's say we closed in the first week of May, and your first mortgage payment would be due July 1st, and you didn't make your May payment because we closed in the month of May. You'd have no payment in May, no payment in June, and your first payment kicks in July. That sounds like a much better plan and process than risking having late payments attached to a mortgage. And then the third element is, without a loan being considered a cash out refinance and giving you the premium interest rates, you can get up to 2% back on your mortgage refinance, or $2,000, without it being considered a cash out or equity refinance. So for many of my clients, that's $5,000 to $7,000 in their pocket and a reduced interest rate. Interest rates are at pretty much an all-time low, with the absolute lowest point being the week of March, the first week of March. And we can talk a little bit about that too, and what's happening with interest rates and where they're at right now, and what happened with the Fed's fund rate too, if you have some questions on that.
Yeah, well, and let's
go ahead, Dan.
Yeah, let's go ahead and get into that, because I think that's at the forefront of a lot of people's minds right now. I know I just talked to one of my good friends today, and he was saying his exact question was, "Hey, we just refinanced not that long ago, but our current rate is 4.25%. Would you recommend refinancing at this time?" And my response was yes. I mean, of course, it's a circumstance by circumstance situation, but I'll go ahead and toss that question to you, Dawn, for people who right now are on the fence about whether or not they should refinance, and maybe if they're a little bit scared because of everything that's going on right now. I think a big misconception is, every time somebody sees that the Fed is lowering the rate, they think that that's the mortgage rate, but that is not the case. And I'll go ahead and let you speak a little bit more to that.
Okay. All right. First of all, in terms of interest rates, and what does refinancing mean for those of us who are maybe first-time home buyers who have never executed on a refinance before? You are allowed to rewrite the terms of your mortgage at any point in time, as long as you have no prepayment penalty on your loan. And most of us in the United States now have no prepayment penalties on our mortgages. So you can rewrite your loan by refinancing or redoing your loan according to new terms, and choose any type of loan term that you want, anything from 10 years to 30 years and anything in between, 18 years, 17 years, any term that you want. Well, with that, you would rewrite your terms according to 3 things: your income. So you have to income qualify, and unemployment is not one of the allowable sources of income. So income, credit is number 2. So based on your credit score will determine your interest rate. And then number 3 is equity in your house, how much equity that you have. You don't come to closing with any money typically, unless you want to. Typically you use the equity in your home as the amount of money that you need for your equity position or your loan to value position, because the difference between the appraised value and how much you owe is now the down payment percentage that you have. So when it comes to interest rates, I want to get into rates a little bit, and I'm looking at a calendar. Do you want to say anything, Dan, before I start with that?
No.
Okay. So the week of March 1st, the first week of March, nearly 30 days ago, just about over 30 days ago, on March 3rd, interest rates were the lowest point that I've ever seen mortgage rates in 20 years. In history, they were at the very lowest point. That would be April 30th, April 31st, March 1st, 2nd, and 3rd. I locked probably 30 clients at that week. So what was happening was Corona was hitting the United States at that time, and mortgage bonds were starting to sell off in droves. So those investors who have held mortgage-backed securities or mortgage bonds they saw what was coming to the United States, and they started diverting their mortgage-backed securities and their bonds. So bond sell-offs were happening so fast that interest rates fell so rapidly because there was a bond sell-off. So interest rates and mortgage bonds work inversely together. So as bond yields go up, mortgage rates go down. So as bonds were selling off, interest rates were plummeting. That was the most awesome time to lock an interest rate. Well, in the week of the 6th and the week of the 13th, freak out started happening because we were selling off mortgage-backed securities like crazy and mortgage bonds. So the President Trump, got on the airwaves on April 12th. Let me look at my calendar again. It was on March 15th. And when he spoke, he said that we're going to lower the Fed's fund rate to nearly 0%, to 0.3%. Everybody's cheering, right? And we're going to buy bonds on an unlimited basis. That's the key right there. That's what will keep interest rates down. The Fed's fund rate has nothing to do with mortgage interest rates at all. All that is the rate of return that banks pay for a 24-hour basis of selling their money, because when a mortgage closes, they have 24 hours to move that money off of their line onto a mortgage-backed security and so that they can have their money free again. So that's that interest rate. It has nothing to do with us, except it means that we're going to get really low interest rates of return on our savings in the bank. So the Fed's fund rate has zero to do with mortgages, just like the Treasury bill has zero to do with mortgages. However, what President Trump said was key, that we're going to buy basically bonds on an unlimited basis. I'm sure that faucet's going to turn off at some point, but that means that interest rates are extremely low right now, and they are very volatile too. So what happened was the week of the 16th of March, looking at my calendar, rates were like this, dicey. And I didn't lock any rates on the week of the 16th. I didn't lock any rates on the week of the 23rd because there was like this push and pull going on. And then the week of the 23rd, rates have come down, and I locked maybe another 15 or 20 clients. The week of the 30th was very tumultuous as well because mortgage companies started shutting down. We had mortgage companies imploding last week, and I'll talk a little bit about that. So mortgages stopped lending on government loans if your credit score is below 640. So we were underwriting and closing loans just the week before as low as 580 credit scores. So if you did not have a loan that's locked, then your mortgage pre-approval is no longer valid and no longer active, because you have to have a 640 credit score in order to finance with any type of government loan. That's FHA, veteran loan, or rural development. Not only that, Wells Fargo, who is the largest buyer by far of all mortgage-backed securities, government loans, stopped buying mortgage-backed securities, stopped accepting any under 680. So that has definitely put like a stopping point on any government loans when you're under a 680 or 640 credit score. It's still possible to get a loan at 640 to 680 government-wise. It's definitely possible conventional, and it just has become a lot tougher and more expensive.
That's really good information, Dawn, and I know it's it's kind of a lot for people to take in. So hopefully that people were following along with that and they could understand that. We do have around 50 plus people watching. I just want to reiterate what we've been saying since the beginning. If you're new, please feel free to type a question, type a comment, and then Dawn and or myself will answer it as we see fit. One of the most common questions that I've received is what people are asking me, what is this going to look like for the real estate market when it's all said and done? We've been in an ever increasing market that has been exceptional for sellers, in particular for really about the past 5 years. And people want to know, what is it going to look like? Is it going to stay the same when we're, all said and done with this? It's a tough question to answer. And I think that if you ask 10 different people, you might get 10 different answers. My personal opinion is that it is probably really going to tighten up even more than it already is. The reason that we've had such a seller's market in the past, 5 or 6 years is because people got so far underwater on their mortgages during the Great Recession that they really didn't have a lot of equity in their home to be able to go out to market and try to make any sort of profit on it. And the way that it's shaking out now, the interest rates aren't appearing anyways, especially with what you just explained, which was really good. The interest rates aren't getting any higher, and that obviously brings more buyers into the market who maybe sometimes otherwise wouldn't be buyers if the interest rate were higher. And that alone is enough to make it a seller's market. But then in addition, you're going to throw in, lingering pandemic fears, for sellers who maybe are now going to say, well, we just refinanced, we have a super low interest rate, and we really want to stay here a little bit longer, let the market stabilize and go on and see. My advice, if you were considering selling, and it's not just a sales pitch, it's the honest to God opinion, sell it. I really think that it's going to turn more into a seller's market, because I just don't think that you're going to, there's already low inventory. I just don't think that you're going to see the same amount of people who are even in the market before in the market when this is done. I still think there's going to be significantly more buyers than there are sellers. And I think that people who are getting laid off or furloughed, they are going to, obviously be in their house right now, and they're going to want to get back to work and stabilize things a little bit before they consider selling their house again. So that's really my opinion. I mean, if you're looking to sell, I still think it's going to be a great time to sell. I would definitely encourage you to. I think you're still going to have more buyers than you are sellers, and that's still going to make for a great seller's market. If you're a buyer, like Dawn said, you got pretty much near historically low interest rates, and if you have the ambition or the opportunity to go out and try to get one of those deals, even right now, if you're a buyer right now and you're willing to write an offer on a house that you may only be able to see the pictures on, or you may only be able to get a virtual tour, it's a great time to get a good deal that you otherwise wouldn't have been able to have for the past 5 or 6 years. And you can make that offer contingent upon, seeing the house within 24 or 48 hours of this order being lifted. So it's definitely a lot of give and take.
All right. Good information, Dan. We have about 5 or 6 more questions, so I'll zip through them.
Go ahead.
And keep the questions coming. Appreciate that. So one of the questions says, how is short-term unemployment affecting people getting a mortgage? It is absolutely affecting people getting a mortgage. If you are unemployed, if you're self-employed and your business is shut down and we can't prove that your business is up and running, we cannot close. So temporarily, you are in a holding pattern. Until you're back to work, we're not closing on your mortgage. So it is decimating to those people that are unemployed. So unemployed means that you cannot close on a mortgage. Dan, what's the numbers of people that filed for unemployment nationwide and then also in Michigan? You gave those, I think, to me yesterday.
Yeah, the most recent numbers that I've seen, I think they have estimates for what it's going to be this week, but last week it was 6.8 million people in the United States, and it was over 500,000 people in Michigan alone.
So Shelley asked, what about if property taxes are included in a mortgage payment? That's a great question. Absolutely, you can refinance if mortgage payments are included. What happens is as you close on your refinance, you either can choose to bring money to closing. Let's say it's $2,000, knowing that you're going to get that escrow money back, or you can have me rebuild new escrows into your refinance and receive that money as a refund check back from your current servicer after closing. and taxes and insurance can continue to be included as your payment in the future. If you move into forbearance and you don't make a mortgage payment for 3 or 4 months, your mortgage company will continue to make the taxes payments. They will continue to make the tax payments. I'm confident of that because taxes take a first lien position, and so the taxes will continue to get paid. Mary has a wonderful question in which I'm going to be very forthright in answering. Her question is, how much of my pipeline had lost their pre-approval? So I had to make 27 phone calls on Wednesday. I called anyone who had a 650 credit score or below. Of those clients, I talked to 5 clients, and of those clients, 4 already were doing things to improve their credit score. And so, because when I meet with my clients, if your credit score is under 620, you get penalized in a higher interest rate anyhow. So I'm always talking to my clients about what they can do to improve their credit score. And I run what's called a credit analyzer. After I run your credit report, that tells you specifically what you can do, what to do specifically to bounce up your credit score within 30 days and the probability of you getting there. So I really had more pleasant conversations than I expected to on Wednesday when I had to dial those clients. I had to leave a lot of messages that said, without saying your pre-approval is not valid, kindly saying, if you're looking to buy in the next 60 days, do not start looking for a house before we talk and see how to increase your credit score above 640, because at this current time, you're ineligible to buy at this current time. If you're not looking for more than 60 days, then call me when you're ready to start looking within a 60-day window so that we can look at this and figure out what you can do to increase your credit score. My advice on new clients is if your credit score is below 680, we should meet. We should do a Zoom conference call or go to a meeting conference and look at how you qualify now, what you need to do to get qualified, how to increase your credit score. For example, I know I can run an analyzer and say that if you pay down your Bank of America credit card from a balance of $300 to a balance of $10, it'll increase your credit score by 22 points. That's how specific it is, specific to each person's credit report. So it's pretty cool. Susan asked a wonderful question. She wants to know, and Brandon, I'm not sure I understand your question. It says, talk about the staying power of equity, please. Could you elaborate on that question a little bit more? That would be awesome. So Susan is asking how they're doing appraisals for refinancing. 70% of the time I'm getting drive-by appraisals or desktop appraisals that the appraiser's not having to go into the house. 30% of the time I'm having to have an appraiser go into the home, and they are willing to do so. It's not easy finding an appraiser that's willing to go into the house. They spend 10 minutes in the house. Typically the owner of the house leaves for a period of 10 minutes. The appraiser goes into the house, appraises the property, leaves the property, takes their photos that they need, and then the owner goes back in and sanitizes and cleans the house thoroughly, and business is carried on. Peter asked a very important question, and yes, the answer is yes, Peter. Am I seeing an increase in low appraisals? I am so sad to say that I am, and it's not. I just had a short appraisal on a purchase already. It baffles me because we're only at April 7th, and this has been just over 30 days, and I'm seeing short appraisals. So either one of two things are happening, maybe one of three. I cannot imagine the sales data has caught up to an appraiser's field book yet, right? Because we had 1 month of March with sales data low, that should not mean appraisals are coming in low. So what I think might be happening, it's insane, but what I think might be happening is I think these appraisers are a little skittish. I think these appraisers are appraising properties conservatively, which is strikingly odd to me because these are the appraisers that are willing to go into houses that are actually working and doing the work amidst COVID, yet they're appraising properties and they're coming in low. And I'm disputing appraisals, and I'm getting appraisals overturned, and I'm having to do second appraisals. It's a fight. It's a fight right now to keep my deals together. I just had an appraisal that came back at 184 and the purchase price was 196. And so either the agents didn't comp out the appraisal well, or there's some trickle down effect happening. And I think it's more of the latter. I think that maybe the appraisers aren't kind of comping these out because they were just aggressively. Remember, we had multiple offers just 30 days ago. We had people being outbid. It came to a screeching halt. So I think that that's what's happening. But I have to say, Peter, in 90 days, when we don't have that sales data, we're going to have short appraisals. So if you were planning to stay in your home, and if you're planning to stay in your home greater than 1 year, definitely greater than 2 years, now is the time to refinance. If you are not wanting to stay in your home and you want to move, do not refinance. Do not refinance if you're going to move in the next 12 months to say 24 months, because it takes closing costs. Even if you have a free loan, you have things like prepaids that get added to your loan and payoffs, and your loan balance will go up. And you don't want that to happen if you're wanting to sell, because you don't want to swallow any of that equity up. On the other hand, refinancing is awesome if you're going to live in your house for 2 years usually or greater, because you can recoup those closing costs in just under 2 years.
So I wanted
to. So Brain, go ahead, Dan.
Yeah, I just wanted to quickly say, when you were talking about the appraisals coming in low, and part of that is that you said there may be agents not going and agents not. This is one of my frustrations. I always go to my clients' appraisals. I go there to make sure that appraisers are seeing features of the home that you may not see just in your on paper appraisals. And of course, that's what, good agents do, and we are not allowed to do that right now. The appraisers are telling us to stay home and to not show up. And so the best you can do is your own market analysis and your own explanation of the features that may not show up on paper. And that's just never always the same, unfortunately. So I think it's definitely a little bit of both, and it's a little bit out of our control. I know you do have more comments or more questions. Sorry, I kind of cut you off there.
No, that's great, Dan. Thank you. That's wonderful information. And thank you for going to the house for appraisal. That's really appreciated and really helpful. Thank you for that. So Stuart, hi Stuart. It's great to have you here today. Stuart is asking, what is the interest rate on a 30-year mortgage and a 15-year mortgage? So I'm gonna explain where rates are at right now, and explain where. So I'm gonna give you a quote on that, but I wanted to kind of give you a predecessor to that. So mortgage market rates have been extremely volatile. For example, I've seen them go as low as 2.75, and then in a period of 72 hours go up as high as 4.75, 200 basis point swing. So 2 percentage points from 2.75 to 4.75 in as little as from a Friday to a Monday. So if you are wanting to refinance, the best thing you can do for yourself is to get your loan application in. Kristen's going to share out what's called HomeBot, HomeSnap application, where if you wanted to apply with me, you would fill out your HomeSnap application, and then I would call you and give you market quotes, and then we would watch rates and then lock at the right time, because mortgage rates are like bouncing all around. And so sometimes I can't get that awesome rate that I want to unless I do it on a 2 to 24, like a 2-week lock to 20-day lock. So if I have your application in, if I've already disclosed the rate that I want you to get, that you want to get, and we've made application, and I've had title work done, we've practically gone through underwriting, I can then lock the rate and go to closing within 2 weeks. And that is making all the difference on capturing these low interest rates, because they're hitting low points at like on March 3rd, and then again on March 15th, and then not again till March 25th, and then today on April 7th. It's like, it's so sprinkled in there. So Stuart, to answer your question, the rates that I've seen that make the most sense is approximately 2.875 on a 15-year mortgage, as what I've seen on average at those low at the good to low points, and then on average 3.25% to 3.5% on a 30-year mortgage. I'm usually seeing 3.25% if you're not looking to take out cash, and I'm talking about having 760 credit scores and a good equity position. So I'm obviously talking about your higher end clients that have really good credit scores and good debt to income ratios. But even some of those FHA loans with 700 scores, I locked in a client today at 3.25%. I locked in another client today at 2.875 on a 15-year. So I think that that's probably the window, 2.8 and 3.25, and then it adjusts from there depending on your credit score and if you're taking out cash and that sort of thing. Okay, Brandon, let's see. Yeah, I agree with you. Brandon says, I feel like the windows is small here for a refinance. I could not agree more. And sometimes, Brandon, those windows, like I have an application in, and sometimes I can't do anything but lock loans because I have a 4-hour window of a low lock period, and then rates shoot back up. It's completely insane. So I don't know who you are and how intelligent you are, but you definitely know your stuff. Okay, so maybe my understanding is wrong, but it's important that when the appraisal comes through, the equity can be impacted. I'm going to reread the question just so I can understand it. I feel like the window is small here for refinance. Maybe my understanding is wrong, but it's important then the appraised value coming through. Otherwise, your equity could be impacted. Oh, Brandon, yeah, you're preaching to the choir. Your appraisal is very important. So if your value doesn't come in, like I have a client that we expected his appraisal to come in at $250,000. He thought it would. After talking with him, he was more under the understanding that it would come in around $210,000 to $215,000. The appraisal came back today at $196,000. If I don't fight that appraisal and get it overturned and get value increased and get a new appraisal, he is not going to be able to refinance and take out any cash. And he was in a 15-year mortgage paying down his principal at $700 a month with 20% equity position. I know I'm talking a lot of lingo. It just doesn't make any sense that his appraisal came back short today. So yeah, appraised value is everything. But usually right now you have that window because sales data is on the last 6 months. So November, December, January, February, March, April is the window that comps are being taken right now. If you're in suburban. If you're in rural areas like Dan is in Elmont, you can go out 12 months for your sales data. So the window is small. In 90 days, I'm going to have trouble with appraisals. I'm not even having really trouble with appraisals like I'm going to have if this thing continues into July and August, because that sales data is going to be smaller and smaller. Now is the time to refinance because your window is going to. You're right, Brandon. You're right. You're
Brandon
totally right.
Brandon is an inquisitive fellow Elmont Raider. He knows what he's talking about.
You know him? Do you know him?
Oh
He's
yeah,
kicking some major butt on these questions.
Yeah.
Okay.
Yeah.
James asked, Dawn, would it be worth looking into refinancing even if we were likely to buy in the next 2 years? I would say no. I'm not a proponent of it unless you can get a no-cost refinance or the break-even point is going to be 10 months or less. I'm not a proponent of you refinancing if you're 80% probability going to sell in 2 years. Yeah. I'm with you on that one, James. That's a good question. We talked a little bit about credit scores. We've talked a little bit about market. And I guess, Dan, I guess I could talk. Go ahead.
There is a question here. Somebody asked you, Dawn. She wanted to know if you felt comfortable giving a percentage dip in what the home values are going to be in the coming months.
Dan, you're probably more qualified than I am on that one.
It is a tough one, and she is a fellow realtor, so hello. I think it's a tough question to.
It's speculation. It's speculative.
Put a number on. Mm-hmm. Yeah. Pam Bryan from Caldwell Banker. It is a tough one to put on. How much are home values going to drop? Versus, it's almost like you could look at it several ways. Dawn, what you've been talking about with your appraisals coming in low, and not justified that they are, what is somebody willing to pay for the house versus what is it going to appraise at are two different things. It always has been,
Right.
but I think more so in the coming months, that is going to be the case, because if appraisers are going to have to look at X number of months prior sales data to make their decision, and you still have a strong seller's market, which I still think it's going to be, the actual sales price of the home shouldn't really change that much from what it has been increasing the past 5 or so years. But if appraisals are going to come in short, it's really going to throw a wrench into things, because that's when you're coming back to the table to ask buyers to make up the difference in cash, or if you're the seller and you're motivated to get out of there, you're going to lower the price. So it's a tough question to answer. And I think you have to look at it two ways. I don't think that the actual price that a buyer is willing to pay is going to drop very much, if at all. But if the appraisals are going to come in short, there's going to have to be an adjustment and a meeting of the minds there from the buyer and the seller.
Yeah, I don't have any good answers to lend into that because it's all speculative, I suppose. Yeah.
Yeah, it's definitely a tough one. So, we're approaching our 8 o'clock here, which we had this scheduled for 1 hour. I think that it's been really, really good. I hope it's been good for a lot of people who, have had questions or have questions. We'll put our contact information in the comments. If anybody has any questions, feel free to contact us. We're all kind of in the same boat, and as kind of experts in our field here, we're happy to help people with what is going on here. And like Dawn said, I think there's a HomeSnap link in the comments, and if you go ahead and you click on that and you kind of fill it out, a couple questions, Dawn will be able to give you a much better answer as far as what your rate might look like on a refinance. But above all else, and I know this kind of shifts some things over to Dawn, but I would really, really strongly encourage people who are out there watching or have friends or neighbors. We talked about it. The window for the refi is probably going to be really, really small. And if you are in a position right now, Dawn, correct me if I'm wrong, but I would say if you're paying anything above 4%, maybe even a little less than that, and you're not planning on making a move anytime soon, I would definitely look into refinancing. I mean, some of those rates you were saying earlier, Dawn, on the averages, I mean, in the mid to high 2% for a 15-year mortgage, that's unheard of. I mean, that's as close to free money as you're going to get.
I thought my rate at 3% was great. I have a 15-year at 3%, but my clients have me beat now.
Yeah.
They have me beat.
It's like I've been telling people who are looking to cut costs. Some people are looking to get rid of their cable or any other things that are deemed not necessities. And I'm saying, why don't you look at your mortgage? I mean, there are people right now who could literally drop hundreds and hundreds of dollars per month on their mortgage. And if you look at it over the lifetime of your loan, you're sometimes talking $100,000, maybe $200,000 if you have 20 or so years left on your mortgage. I mean, it is a really, really significant number. So I strongly encourage people to go ahead and get with Dawn and get a hard number on it. Get a hard number on what your numbers are going to look like if you did refinance right now, because it is, I saw a saying the other day that through any adversity there is opportunity. This is your opportunity. This is one of your opportunities through all of the adversity that's going on right now.
And then in closing for Dan, one of the questions that Janae asked is, is what's going to happen with sellers and buyers? And I think there could be possibly pent-up demand. So if you're looking to sell, now would be a good time for you to get in touch with Dan. You could send him some photos. He can run some market analyses and see what your home is going to be worth and what it could possibly sell for, and have him kind of line up for you and work on giving you a market analysis so you can see what that would look like. And on the buying side as well, if you meet with me through something like this, like a video, we'll go through your payments, your out of pocket, and then Dan can get you started on some search engines so that you can see what kind of houses are out there to decide if it's something that you're going to want to stay or and refinance, or you're going to want to sell and buy. Thank you for watching. We're really appreciative. Thank you so much.
Thanks, everyone.